Okay, good afternoon, people. All right, thank you for joining this fundamental crash course today with 3:15. Sorry for the 15-minute delay. All right, thank you very much for joining. My name is Joe. I will be one of your main speakers today. And yeah, there will be some people joining in the session later while we are having this introduction due to the technical issue just now. But all right, no worries. If you have not connected your audio, please do so on this bottom left corner. All right, and I'm very interested, very excited to share this information today with with one of my friends, Zhi Pei, which will be one of the main speakers today also. All right, before I move on, happy holiday to all of you. Happy Deepavali, happy movie day, happy annual leave for every one of you. All right, so have a very great weekend. We are trying to make this a productive and useful session for all of you today. So hopefully everyone will learn something after this session. All right. So today's session is about investing. All right. But before investing, the first thing I want every one of us to know is you need to know the fundamentals of the companies. All right. Don't invest in something you don't know, or you'll be very emotional. You won't last for very long. All right. Knowing your company's right, investing in the company with the strong belief you have. Okay. So first, before I start any sharing, disclaimer, anything I'm presenting today is just for sharing purpose. I'm not recommending you to buy or sell anything. Please do your own due diligence after any stocks or any companies that we analyze today and use any content today at your own risk. So apart from the disclaimer, I would like to highlight to you what are the takeaway you'll be getting away from our session today after this 1 or 1.5 hour session. All right. So first, our main goal is to let everyone today to understand what exactly is fundamental analysis. All right. So fundamental analysis, you know to learn where and how to find a company's financial data and how do you analyze a company, how to select a strong company from a list, a bucket of companies you have, and eventually with all these strong companies that you isolate, that you selected, you can then create your first watch list to serve as your first potential investment. All right. So without further ado, I will now do some simple introduction about the speakers of today. So first, of course, it will be me. My name is Joe Pong. I'm born in Malaysia. I graduated from NTU Singapore. So right now, I'm a full-time R&D product development chemist in Singapore. I started my trading and investing journey mid-year last year, 2019. So when I started, right, I don't really have proper guidance throughout a very proper guidance throughout my journey. So I paid a lot of tuition fees to the market to learn different strategies, to learn from my mistakes. Yeah. So yeah. So that's how I learned throughout this 1 year to gain knowledge on how to invest, what are the things that I should do, what are the things that I should avoid. And yeah, it's because of this year I pick up so much about fundamental analysis, technical analysis, how to enter, how to really invest safely, but not trading or investing blindly, or you will be just, gambling the market instead of investing. And trust me, I lost a lot of money in investing. So that's why I'm here to share this knowledge with you. I don't want any of you to walk the same path as me. And right now I'm on track on a 5-figure investment portfolio. As I checked yesterday, I'm actually hitting 5-figure investment portfolio already. Yeah, so right now I'm growing this portfolio and hopefully everyone of fresh investors that are out there that are listening here in this session today, you can hit this goal together with me and we should learn and grow together. All right, so next introduction will be Zhi Pei. Zhi Pei, you want to take the mic over and have a quick introduction?
Okay, hello everyone. My name is Zhi Pei, and this an Instagram account that I created for recording my investment journey. It's called a Journey to 1 Mil. So if you want to check out any updates, I will be updating in this account. So yeah, I'm born in Malaysia, and I'm a graduate from NTU Singapore as well. And currently, I'm a project application engineer in Singapore. And basically what my company do is we make automation machines. And on a side note, I started my stocks and options trading in this year alone, around June period. And then I'm currently managing a diversified portfolio as well. And right now my target is to hit 1 million, as you can see the Instagram account, the journey to 1 million. So yeah.
Okay, so Zhi Pei, when is your goal to hit 1 million? Just curious.
The target is about in 5 years time.
5 years, okay. Okay, I will catch up with that. All right, thanks Zhi Pei for the quick introduction. So without further ado, yeah, so this is just to show you guys that we have a previous session on this, which is called things to know before you invest. So this is actually the second session we are having for our investment diary group. All right, if you missed the session, please take a screenshot of this page and you can log into this URL later to watch all the recordings. So this is a 3 hours long recording, which I separate into 4 parts. So take your time to go through them. Yeah, I believe those are very useful, and those are the session and lessons I learned, paid or unpaid. So sharing for free to all of you now. All right, please take a screenshot of this and I will move on. All right, the other thing I want to mention is that today, whatever we are sharing, we really hope that you can bring something back into your mind after this session. So please make full use of the Zoom chat group. So if there's anything you want to ask, you are not clear about, please make full use of the chat room in Zoom chat. So we'll have a Q&A session in the end. All right. Okay. So one of the main reasons that I want to host this Zoom meeting today is because there are many members in the investment diary group chat who have been PMing, sending me a lot of PMs about questions related to this. All right. So where do I look for good company? They are quite lost when they are trying to look for companies. They don't really know the companies they are looking for. Is it a good company? Is it a strong company? What informations are there for them to justify their choices? All right. So if they have started investing, they don't really know whether the choice they are choosing, is it a good company or not. So when the company price falls, they tend to be more emotional. They don't really have a conviction or something to back them up on the decision they make. Okay, some people are just lost, like many fresh investors who join the group, because in most of the time I will be sharing a lot of technical charts, a lot of news. But if you are not trained to look at the fundamentals or you don't know the basics, you can get quite lost when you're in a group. So there are so many informations out there in the internet. So how do you start? All right, don't worry, don't be like Jackie Chan here. So just relax. Welcome to the fundamental class. Today we're going to teach you how to look into the to the root of the company, to the fundamental of the companies, to know the data, and with that you can back up your confidence and have a peace of your mind. All right. So if you are ready, let's start this session. Okay. Oops. All right. So first of all, before I start the fundamental analysis, I would like to highlight these are the main 4 things that I will be. Let me just switch off my. Okay, is this better? All right, is this better? Okay, so yeah, before I go through fundamental analysis, these are the 4 investment essentials personally that I'm using. All right, so the first one on the top will be fundamental analysis. So before you go through any company you want to invest, fundamental analysis is a must. All right, you need to understand the company financially, how well they are growing, how good they are managing their financials before you invest. All right. The second step I will take is technical analysis, which I will look at the charts, I will draw some lines, draw some supports, and then know where to enter. Okay. And the third and the fourth will be more on a strategic and a personal basis. I will try to know what are the funds that I need to allocate and what are the investment strategy for myself. All right. But today, don't worry, we'll be covering only the very first step, because that will be the most important one for all the fresh investors or new investors out there for you. which is the fundamental analysis. All right, so are you ready for fundamental analysis? I'm not sure. Can I see the chat group? So if you are ready, please type in ready in the chat group. All right, type in ready, so I know you are ready. Okay, Zhi is ready, Jeremy is ready, ZS is ready. How about the others? Others are good? Okay, you are ready. All right, thanks for rushing back, Fira. Okay, all right, chat group is good. Mandy is ready. All right, let's get kicking. All right, fundamental analysis. So by the way, if you hear any echo or you can't hear me well, please type in the chat group. All right, I can't be following up with every one of you directly. Okay, so first let's define fundamental analysis. All right, so this is the definition I got from online. So basically, fundamental analysis, you are trying to use data from balance sheets, from a lot of indicators and a lot of key ratios, basically all the financials that are presented about a company to measure whether the value, the intrinsic value of the company fits, and do you believe that the company is growing strong in a long term, in a proven track record kind of thing. All right. So why do we do fundamental analysis? It's basically just to answer these ultimate questions. All right. You can have many forms of this kind of question, but ultimately this will be the questions that every one of you should be answering. All right. So the key essence is to know that fundamental analysis can help you to understand the company and whether the company is worth investing or not. All right, makes sense? Many of you have different questions like what are good companies, what are strong companies, is this company making money? How do I know? Can I invest this for a long term? All right. But in the end, if you sum everything up, this will be the sentence. How do I understand the company and is it worth investing or not? All right. So fundamental analysis can help you to understand and answer this question. All right. Before I jump into fundamental analysis, the first thing I want to also update you all will be something on your mindset. So I call this a value mindset. All right. So when you are investing, do you start by looking at the price of the company or do you start by looking at the business itself? All right. So from here, we can see that there are two jigsaw puzzles here. On the left will be value, on the right will be price. All right. So how many of you are looking at the stock price before you invest? How many of you are actually diving into the business into invest? Can you type in the chat box to let me know? Because I know a few people here, like me earlier, we actually look at the stock price. We don't really care what the business is doing, all right? So if you are a business guy, type in business. If you're a price guy, type in price, okay? Value versus price. So right here, what I want to give you all is a concept that value and price. All right, I saw someone type in price. Okay, never mind. That's something I do earlier on, okay? But right here, value mindset, I want to brainwash you all to be more value minded. Okay, take note of the value that you are investing instead of the price of the stock price that is offering to you. All right. So let me give you an example. It can be very vague at first. So I want to bring in this example very quickly. So there are two companies here. On the left will be company A. On the right will be company B. All right. Company A, as you can see, each unit of the stocks costs only 0.59 euros. On the right side, we have this company B. Each stock unit is trading at 188.62. All right. I'm not going to tell you which company is this, but if you are a fresh investor and you know company A and company B, will you say that company A is cheaper than company B in this sense? All right. If you look at the stock price itself, will you invest in company A or company B? All right. Let me know your choices and I will show you the answer later. Which company will I be investing or what are the truth behind company A and company B? All right. Just type in the chat group. If you choose A, type in A. If you choose B, type in B. Oh, Pizza type in B. I think you are familiar with company B. You pay type in A. Okay. Anyone else? No one? 3, 2, 1. Okay. Looks like, all right, there's someone choosing A, someone choosing B. Let me give you one real life example. Yeah, this is an example I encountered recently about buying smartphones, all right? So how do you link buying a smartphone to price and value? So I'm giving you these two examples. Let's say today I need to buy a smartphone, all right? So this phone I'm showing here with, okay, this is a Samsung. These are the two features that I will be comparing, all right? The first will be camera, the second will be battery. Of course, when you are buying a smartphone, there are many parameters you need to look at, but for simplicity, for simple understanding, we'll just compare these two, all right? So this will be the first model. Let's look at the camera. We have depth camera 2 MB, main camera 13 MB, ultra wide 5 MB, all right? And the battery life is 4 mAh, which is a typical standard battery. And how much is it costing? This phone right here, we just need $150 to buy it, okay? Take note of this price, 150 for model A, correct? With this kind of specs. And the second specs we are getting, this is smartphone B, all right? So smartphone B, again, I'm comparing the battery life and the camera only, all right? There are many features behind which we should ignore by now. Okay, let's look at that camera. Previously, model A, you are having 2 MB. Right now, we are giving you an upgrade to 5 MB. Main camera, it used to be 13 MB, 13 MP, sorry. Now it's 48 MP. Ultra wide camera used to be 5 MP. Right now, it's upgraded to 12 MP. And I'm giving you an additional bonus of camera, all right? I have this macro camera, which brand A doesn't have, model A doesn't have, and it has a 5 MP camera, all right? So right now the price is $398, okay? After discount, it's $398. So let's put them side by side. Model A on the right, model A on your left, model B on the right. So the price, as you can see, the price is very different for two models of the smartphone I'm showing here. 150 versus around 400. In this case, would you say that price and value, they are two very different things, all right? You are paying different price for different models, but the value you are getting essentially from these two smartphones are very different. So when you look at stock price and invest, you might not be getting the best value that you can get from a company, all right? So good companies, I'm not saying every time, but many times good companies, their price are more expensive because they can bring you more value compared to a very cheap company, all right? That's one of the analogy I'm bringing. I hope you can remember this Samsung smartphone example for two different kind of models, all right? So this is a very good quote by Warren Buffett, which I like it a lot. Price is what you are paying for, but value essentially is what you are getting from what you are buying, okay? So this is what I want you to take away from this session. So just now, let's come back to company A and company B. Company A, we have a few people choosing here. 0.59 cents, a very good bargain. Company B, 188 USD is very expensive if you look at the price. But let me show you what are these two companies, all right? Okay, on the left is my personal previous favorite, Wirecard. Right now is 50 cents, 60 cents. PayPal as of yesterday is 188 USD, all right? So I personally invested in both of these companies, okay? So as you can see, Wirecard used to be around $100. And for many reasons, it dropped into 0.59. So if you just look at the price itself, Wirecard is very cheap. It used to be $100. Right now it's less than $1, less than a euro dollar. So it's a value buy, right? Almost 99% discount. But is the company generating the value to you if you are buying this company? On the other hand, PayPal, is expensive, but PayPal, comparing the value itself, is PayPal worth the value that you are paying for? 188, all right? So essentially, price and value, please take note. Price is what you are paying for, value is what you get. And how to do a valuation on the company, I will pass it on to Zhi Pei to brief you on what are the fundamental analysis you need to know, what are the parameters that you need to see. There are so many information when you look at the company financials. Don't worry, we'll just dive into the important one, okay? So last slide from me. In order to receive the value when you buy a stock, you must what? So I can't see the word. You must be careful that you're only paying a price that represents a sound valuation. So how to do the valuation? Fundamental analysis, all right? Just because you are buying a stock at value doesn't mean it will generate a high return for you. Please take note of that. Okay, again, quoting from Warren Buffett, price is what you pay, value is what you get. With that, I will hand it over to Zhi Pei, all right? Let's start our fundamental analysis part.
Okay. Oh yeah, you have to give me the right to share the screen. Yeah. Okay, hold on. Okay, can everyone see my screen?
Yep, I'm seeing it.
Okay. Okay, so this is the part that I will be sharing on the short. How do we shortlist the companies, and how do you find companies to invest in? So first thing is that you can look around you and look at the things that you use every day. So for example, you can look at your phone, you can look at your PC or laptops, your softwares that you are using, your apps, your phone apps. These are categorized in technology. And there are also many things such as shoes, restaurants, beverages, personal care, and medications in other sectors as well. So a few examples of these companies are like Apple, Dell, Lululemon, Nike, Procter and Gamble, Coca-Cola, and McD. So I believe all of you will have seen all these brands before, mainly because you have used them. And yeah, I think this is the best way that you can start to look at what companies can you invest in. So there are two ways. So the other way to find companies is by going through a stock screener. A stock screener, for example, in this example is finwiz.com. You can go to that web page and you can screen the stocks by a lot of factors such as market cap, PE ratio, ROE, and debt and equity, etc. So all these terms, I will go through some of them later on during the fundamental analysis. Yeah, so this is the first part of fundamental analysis. So this is called economic mode. So what is economic mode? The definition is that it is a company that is having a wide economic mode is a company which has a distinct advantage over its competitors, which allows it to protect its market share and profitability. So basically, when a company has a very big advantage over its competitors, it has a wide economic mode. And by the companies that we are investing in, we have to look for these kind of companies because they are very strong and they can beat all their competitors. So how do we find the company which has this wide economic mode? First, we need to dive in. What are the economic modes that we are looking for? So there are 4 key points. The first one is network effect. Second one is intangible assets. Third is cost advantage. And fourth is switching costs. So by looking at all 4 points, we can evaluate whether the company has these 4 points. So the first one that I will go through is the network effect. The network effect is a phenomenon whereby there are increased number of users, and because of this increased number of users, they can improve the value of goods or services that the company provide. So, for example, like Facebook, if there are very few users, then the company will not know like what kind of UI they want to make it so that the users can use the Facebook comfortably. And based on the user feedback and more users use it, they can improve on their products and services. And then the second point is that people around you will change your preferences. So for example, if you have many friends from China, they will all be using WeChat instead of WhatsApp. So it will change your preferences of using the applications. And you'll be using WeChat as well as WhatsApp. So in this way, there's a network effect going on. And the other example is Zoom. So right now, because we are using Zoom as our platform to present our webinar. So all of you are also forced to use Zoom to listen to this webinar. So it will change your preferences of using the services and products. So this is the first point, which is network effect. So the second point is intangible assets. What are intangible assets? The first thing is branding. So here are the top 20 most recognizable brand logos, such as Apple, Google, Facebook. All these brands, when you see, then you will know what they do and what their business are like. So this is branding is very important for the great companies. So once you see their logo, then you will know what they are doing. The second part is the goodwill values, which is the value that the companies are providing. So this includes reputation, customer relations, and employee relations. So for example, if you are using iPhones and you like the product very much, then the goodwill values that the Apple is producing for you is very high because because it has a high reputation and good customer relation because you like to use their products. So that is why I fall back to the first slide that I said, is that how do you find what companies that you want to invest in? So you can look around on the things that you like, on the things that you like to use. So this is why one thing is important, is that if you like to use the things, then most likely the company has a good values. So the third thing for intangible assets is the intellectual property. For example, their patents, trademark, and copyright. So these are very important because it's to protect the company from other companies to copy their products. So once other company cannot copy their products, it means that their products are special and unique. So that's why it's very good intangible assets for the company. So if a company has branding, goodwill values, and intellectual property, it has great intangible assets. Okay, so the third point is cost advantage. If a company can sell the same quality goods or same products at a lower price compared to their competitors, then this is called a cost advantage. So this is, I think this point is quite self-explanatory. So if you find the same products online, and if one website sell the product cheaper, then you go for the cheaper one. And the last point for the economic mode is switching costs. So the first one is, it is difficult to switch to other brands and products. So for example, when you use Microsoft Office products in your office, in your workplace, you will most likely stick to Microsoft Office products the rest of the years, because it has a very wide range of products, including Microsoft Word, Excel, and PowerPoint. And all of these are linked together and they are one package. So if you want to switch to other products, the other products may not have the full feature of Microsoft Office. So that's why it's difficult to switch to other brands and products. The other examples are like skincare products, like if you use Kiehl's, then it's very likely you will stick to them unless their quality is not there, and then you will switch. And one other thing is the iPhone. So you'll be hearing a lot of iPhone users that it's very hard for them to switch to Android phones. So this is one reason that the Apple has this switching cost economic mode. So it's difficult to switch to other brands. And the second point is that it is easy to switch from other brands and products. So for example, like Windows laptop and Android phones. So between Windows laptops, you can switch around, like, for example, from Lenovo, you can switch easily to HP if HP give you a better value. So this means that HP has a good switching cost as well, because you can easily switch from others. And if HP provide extra feature that Lenovo doesn't have, then it means that it is difficult to switch back to other brands. So this is what switching cost means. Okay. So this is a recap. To look at economic modes of companies, these are the 4 key points that we normally look at. So yeah, for all this, do you guys have any questions? If you have any questions, if you don't have any questions, you can type 1 in the chat box. Okay, very clear. Okay. Now I will move to the next part of the fundamental analysis, which is the company's financials. So after looking at economic mode, we will evaluate that the company is a great company, and now we want to look into their financials to see if the things they do is profitable or not. So for the company financials, where do we get the information from? These are a few examples of the website that we can get the company's financials from. The first one I normally use is Morningstar. The second one is yahoo.com, Yahoo Finance. And the third one, you can go to the company's direct website to look at their investor relations. They will share all their financial balance sheet and all those things in their website as well. So in this webinar, I will be sharing more on how to use Morningstar to evaluate the company's financials. So what do we look at when we talk about company's financials? There are 7 key points. The main 7 key points that we look at is revenue and net income. The second one is net margin. Third is earnings per share, EPS. Fourth is return on equity, ROE. Fifth, free cash flow. 6, interest coverage. And 7, the dividend the companies are giving. And I will go through this one by one later. There are also extra points that we can take note of when investing in a company. These are debt and equity ratio, price to earning ratio, price to book ratio, and price earnings to growth ratio. So all these are a few indicators that we can look at to evaluate how whether the fundamentals of the companies are good or not. So let's jump to the first the points. So these 7 key points, we want to actually look at the right side, which is the criteria that we want. So for the first one, the revenue and net income, it must be consistently increasing. So let me now share my screen on the website. Okay. So when you Google search morningstar.com, this will come out, and you can search for the company that you want to look at here. Let's say Apple. So here in this page, you'll see the chart here, the stock price. And then there is one tab called key ratios. And by the way, if you guys want to follow my steps, you can do it. You can do so as well. I will go through slowly over here. So the first thing you can click on is the key ratios. And from here, you can click on the full key ratios data. Okay. So in the full key ratios data, you can basically see most of the key points that I talked about just now. So just now, yeah. So just now I was talking about the first point, which is the revenue and net income. It must be consistently increasing. So let's see whether Apple's revenue and net income is increasing consistently. So this is the page. The first one is revenue. Over the years from 2011 up to 2020, the revenue is increasing from 100 billion up to 270 billion. So it is increasing consistently, as well as the net income from 25 billion up to 57 billion. So the first point is a pass for us, for this company, for Apple. So the next point that we will look at is the net margin. The net margin must be consistently above 12% to be safe. So this is the key points that we are looking at. So over at the key ratios, the net margin you can find is below here under profitability, net margin. So the net margin over the years from 2011 up to 2020, it's consistently above 12%, which is pretty healthy. Okay. So let's move on to the third key points, which is earnings per share, EPS. It must also be consistently increasing throughout the years. So let's look at the key ratios. For the earnings per share is on top here, earnings per share USD. And throughout the years from 2011 up to 2020, it is indeed increasing consistently. So this is also a plus point for us. Then the fourth point is the return on equity, ROE. For us, we normally look for consistently above 15%. So let's go back to the key ratios. The ROE is actually at the bottom here under profitability. ROE, return on equity, is consistently above 15%. In fact, it's quite high. So it's definitely a plus point for us. And then the next one, the next point is free cash flow. It must be always positive. So free cash flow, we can find it back here. This is the free cash flow. So it must always be positive. Why must it always be positive? Because free cash flow is actually the cash flow that the company have. If the company have a negative free cash flow, means it's losing money. It's not. It doesn't have any cash to use to grow the company. So it's best to look for a positive free cash flow, as it is more stable as well. So for the six key points and 7 key points. So for the 6 is interest coverage. We are looking for more than 4. What does this number means for interest coverage? The interest coverage number means that the company has enough cash to pay 4 years of interest for their debt, for all their debt, for their loans. So if above 4 means they have more than enough money to survive for the next 4 years by paying all the interest. So where do we find this interest coverage? Is back to the key ratios. The interest coverage is right at the bottom here. From 2013 onwards, it's still well above 4. That means in 2020, Apple has actually enough cash flow to pay off their interest for 24 years. So it's actually very, very good. So the last point is actually dividends. So this is for the companies that do give out dividends. Some companies do not give out dividends, so it's negligible to look at. So the dividend they give must be consistently increasing as well. So let's see the Apple's key ratio. Over here, dividends. So the dividends are also increasing throughout the years. Now it's about 0.8 USD per share. So yeah, when the company is not giving dividends, it will be new. So there's nothing. But without dividends is still okay, because it means that the companies are still looking to grow their company very fast. So it's still okay if they are not giving out any dividends. So is everything clear at the moment? Or is there any information that you are missing out and would like me to explain more? You can type in the chat group.
Guys, any question? If there's question, do put it in the chat group, and both Zhi Pei and me, we can answer up until now. So Zhi Pei just covered the 7 key points when we are going through the company financials. And this will be the main 7 key points that you need to use when you are doing your FA analysis. Okay, so if you didn't catch up, you can take a screenshot of this. And I have posted a link on Morningstars in the chat group. So if any one of you want to follow what Zhi Pei has did, feel free to copy the link, paste it in your browser, and you can use it in the Morningstar.
Okay, any questions?
If there are no questions, you can type 1. Okay. All right. So there are no questions, so I will be moving on. The next section for this is the extra points, which we look at as well. So the first one is the debt to equity ratio. What this means is that it's looking at the company's debt versus the company's equity. If the company's debt is very large, very high compared to their assets, then this number will be very big. So if that happens, you do not want to invest in those kind of companies, as they will need to repay their debts and their profitability will drop. So normally what we look at is less than 0.5 to be a healthy debt to equity ratio. So where can we find this debt to equity? Let me share the screen for the Morningstar. So in the key ratios, you can scroll down. You can go to the financial health tab. So once you click on it, you can see their assets they have and their liabilities. And at the end is actually the debt to equity ratio. So for Apple, the debt to equity is actually increasing throughout the years. Probably they are doing some investments or some expansion in their business. That's why they are having more debt. And this 1.5 is actually more than 0.5. So this is something to look at, but they do have a healthy free cash flow and a healthy interest coverage. So I think it's kind of balancing out. So this is something you want to take note as well. So for the second extra points, which is the price to earnings ratio. The price to earnings ratio means how much earnings, how to say, 15. Okay, normally we look at the price to earnings is less than 15 is a healthy one. This means that it takes the company 15 years to pay the price, 15 years of earnings to pay the current price of the stock price. That is what we normally look at. Is if it's less than 15 is the best case. But most of the time, a company's price to earnings ratio is very high because they are growing very fast. So where to look at for the Morningstar is this part. So you can go to the valuation here. You can click on the valuation. So here you can look at this price to earnings ratio. So throughout the years, it's about 17, 18, 13, and it's quite high for 2019 and currently 2020. And the 5-year average is 18. So normally this is extra indicator to look at if you are looking to invest in a long term and you are looking for value. If let's say, for example, a growth company, you can compare the current PE ratio with the 5 years average. If the current is less than the 5-year average, it's also okay to invest in if it is not below 15. So that's what we also normally look at, one of the points. But this does not mean that you only look at this particular point, and if it's okay, then it's okay. You must look at the whole picture and compare all the points. So yeah, let me go to the third point. The third point is the price to book value. The price to book value is actually a company, when they sell off their company now, how much of the price they can pay you back. So it's ideally it's less than one, less than or equal to one. But most of the case, the price to book is also very high compared to normal companies. Normally, the companies that is close to one is banks, companies like banks and financial companies, because they do not grow very much. So where do we find this price to book value? Is actually on the same page here. Price to book value. So currently Apple is 31 price to book value. And normally we compare with the 5 years average as well to judge how is it right now. So it's pretty high actually. And the last point just now is the price earnings to growth ratio. So what this looks at is that because the price to earnings doesn't take into account the company's growth. So if a company is growing very fast, the price to earning ratio will be quite high. So you want to use the price to earnings to growth ratio to judge whether the price to earnings is the increase of price to earnings is justifiable by the company's growth or not. So this is the last thing, extra points that we can look at, which is here, PEG ratio. So currently the PEG ratio is 3. That means that the price to earning is higher than the growth, projected growth of the company. So normally it is best to invest when it is around 1 or less than. If it is less than 1, means the company is growing very, very fast, but the stock price is not moving up at the same rate. Yeah, so these are the 4 extra points. This is more in-depth to look at now. But these are just side points that you can take a look as well if you would like to. Yeah. So any questions on these 4 points? If no questions, then I will move on. So the next, yeah.
Yeah, Zhi Pei, I think there's a question by Jeremy K in the chat group. So yeah, he was mentioning how are the criteria for net margin ROE taken for the 12 and 15%? I think that's a very good question. You wanna take that question?
Okay. Normally we use 12 to 15%, 12% for the net margin and 15% for the ROE. This is based on market norms and experience from experienced investors. So they are recommending this 12% and 15% so that it is a safe margin to know that it is a good company. Yeah.
Yeah. So on my side, my take that the percentage serve as a guideline for you. Okay, it doesn't mean that it needs to be above 12%, needs to be above 15% that you invest. Okay, that's a guideline from as Zhi Pei mentioned, experienced investors, and both me and Zhi Pei, we are also following this guideline. Okay, and as you mentioned, as you see that Zhi Pei shares 7 key points and the 4 extra points. So in total of these 11 group, right? you need to see how much of the different key points actually meets your criteria. So it doesn't mean that, oh, this one doesn't hit, then it's a no-go already. Or unless maybe like say one of the criteria is very far away from what you are aiming for, then maybe that's something you need to take note of. Yep. So yeah, so this will be a market norm and a more selection criteria by many investors, I would say.
Yep. Okay. So the slides after this are actually the screenshots that I took from the Morningstar. So at the end of this session, I think Zhi will send you guys a copy of this PDF. So you guys can go through it. Okay, so this slide is a warning for companies' financials. So what do I mean is that even though a company's financial can be perfect, that does not guarantee that it is a good company. For example, Wirecard. So I will share this in a moment. So here I have opened up the Wirecard financials from Morningstar as well. So as you can see, the revenue is growing throughout the years. The net income also growing throughout the years. The dividends are okay. Earnings per share also growing. The free cash flow is very good as well. It's getting quite a lot recently. And ROE is consistently above 15%. For some years it's below, but still okay. The net margin is above 12% as well. And the interest coverage is fantastic. So based on this, many of us would have thought that Wirecard is actually a very good company in their financials. It's a very strong financial company. But we cannot know this unless we follow some news and reports on the company consistently along the way. If you have been following the news and reports along the way, then you might get some hints on they are having problems with their financial audits and things like that. Then you will be more skeptical on this. But sometimes you will miss these news and reports. Sometimes you will not have time to go through everything about the company. So that's why we need to diversify our investment. Don't put all of our money in one company. So this is the key point that I would like to bring upon in this slide. Yeah. So I think, yeah, so this slide is just a recap on what are the points that we look at for the financials of a company. And later on, the next slide will be a case study by us, by Zhi, and I will hand over to Zhi to continue this.
Okay, all right. Give me a moment. Let me share back my slides.